Today, folks, this video is all about that juicy passive income, those wonderful dripping dividends. For those of you that are actually looking for real returns, monthly oriented dividends for your retirement, or perhaps are trying to compound your way to an early retirement, we're taking a look at the best monthly paying Canadian dividend ETFs today, putting my own opinions aside, purely looking at total returns, including those dividends. We're going to compare it to some sector focused ETFs, including some option ETFs that I know so many of you love out there. So if you're a Canadian, if you're on a path to financial independence to damn well one day retire early, join me on that journey. Hit that subscribe and like this video, because we're going to compare all these performances to the broader Canadian markets. Just like the S&P 500 in the US, I want to know what the S&P 500 comparable is in Canada, and the index that I think represents this the best is VCE, the Vanguard FTSE Canadian Index ETF, which currently over the last 5 years is up 53%. If we just break down the holdings, it's relatively diversified based off market cap performance. So as market caps get bigger, the weighting in the ETF gets bigger. As they get smaller, they also get smaller in the ETF. This is one of the most brilliant systems ever created in ETF history. Rest in peace, John Bogle, a legend of his kind. But we can see Royal Bank at 8%, Toronto Dominion Bank at 5%, even with the trouble some of these banks are having. Shopify's in here at almost 5%. You got Enbridge, Canadian Pacific City, the railways. You got Brookfield Corp, Canadian Natural Resources, Bank of Nova Scotia. I'm sure you've heard of many of these. The sector allocation is mostly in the financial sector because that's what weights most of the Canadian economy. But if we dive a little deeper, we take a look at the fact sheet. What are we paying? Because total returns tend to be exempt of management fees, so we have to be very cautious when looking at returns since inception. But we can see management fees sits at about 0.06% with a 12-month trailing yield of about 2.91%, so just under 3%. And that is not paid monthly. This is a quarterly paying ETF, which, to be fair, this is not that bad at all. If we look at the dividend growth, it is a little disappointing, however, but this is probably because we're seeing new tech companies start to upperweight in this ETF. So the 5-year growth rate is only 6.62%, which really is not, terribly appealing, but we're still talking about an over doubling every decade, which isn't really that bad. Like, this is the base returns. This is what we expect from buying a broader based ETF, with since inception returns being about 9.03%. And I really want you to pay attention to that. So since this ETF has been in existence, which if we go back, has been around for a while, since 2011, we can see again that those returns sit at about 9% a year. Now, obviously, recently the 1-year returns are starting to look incredible because we are in a new bull market. So congrats to anybody that's been picking up stocks a year ago, because you're definitely excelling the inception, or since the average returns 9%, we're like tripling it here, which is just insane to consider. So I want to look at my least favorite ETFs that pay monthly dividends, and then we're going to look at the best ones, in my opinion. Not my opinion, but based on actual performance, of course. But BMO Canadian Dividend ETF is one that I hear about a lot, and the 5-year performance from the capital return is 31%, which does not look that appealing. This ETF has been around for a long time as well, since 2011. And again, the returns have been bleak from a capital growth standpoint. If we take a look at the holdings, it is much more diversified, and diversity tends to lead to lackluster performance, obviously, with Royal Bank, Enbridge, Canadian Imperial, Bank of Nova Scotia. A lot of financials in here weighted at 5%. So we can see that we're already 3% lower weighting in this ETF than we are in the broader Canadian ETF. And if we take a look at the allocation here, 41% financials, 18% energy, 9% utilities, making up the vast holdings. Again, we're paying a massive management fee here, which I do not want to state the severity of a 0.4%. My typical breaking point is about 0.3%. When you get up to the 0.5 and 1% range, I've done the math before showing you how detrimental that is, especially if you're investing really early and you're like 20 years old. You do not want to be giving this much money to managers when there are ETFs that are obviously and dramatically outperforming these, considering since inception the rate of return has only been 7.74%. If we take a look at the yield here as well, it is paid monthly, but it's only 3.77%. So we're about just under 1% higher than, say, VCE, the broader Canadian market ETF, but we're losing another huge percentage of that to the fee. And I really want you to keep that fee in mind, because, like I said, a lot of this time when the annualized performance is shown, it's before the fees. So you could be losing more of that return. If we take a look at the dividend year growth, the 5-year growth has been abysmal. I don't know exactly what would have been causing this. If we actually just take a look at the dividend history here, this could have a lot to do with the fact that they reconstitute some of the stocks. Things might get moved around. I'm not sure, but yeah, basically a decade ago, you'd been getting about 0.07 cents, and today you're getting 0.07. So I'm not sure why there's a lack of dividend growth, but obviously this is why I consider this to be one of the worst monthly paying ETFs. So let's talk about my two favorite, my absolute go-tos, ones that I would add to my portfolio and am adding to my portfolio today, starting with XDIV. We're talking about a 39% capital growth over the last 5 years. Basically, if we dive into this, I mean, look at the trailing 12-month yield. We're at 4.38%. We are getting a much, much higher starting yield. If we scroll down as well, take a look at that management fee, it's 0.1%. So even the management fee is lower than most. Well, it's more in line with the, I think the Canadian broader ETF here is 0.06. So it's really not that far off from the broader based ETF. If we scroll down here and take a look at the returns, it's 10.25% since inception. And the 1 year is 28%. That is absolutely incredible. Like, to get a 10% compared to these other ETFs we've looked at. So let's just take a look at what's driving this. And we can see we have Manulife, Royal Bank in here, and these are upper weighted by almost 10%. The top 4 holdings here are Manulife, Royal Bank, Sun Life, and Enbridge that make up a huge percentage of the holdings. Again, concentration, which is still, in my opinion, diversified, but more concentration will lead to better performance, especially if you're concentrating the better performing stocks. And again, it's mostly financials, energy, and utilities. You're going to see this similarity across the entire Canadian markets. It's just what our economy is made up of, but this has done a very good job at weighting the better performers. We'll also notice TDs in here, but at 8%, a bit of a lower weighting, again, being one of the more detrimented stocks in the Canadian economy as of recently. So if we take a look at the dividends, we're talking about a 7.49% growth over 5 years. Again, also really adding into that total rate of return. Again, making this one of the absolute must own, in my opinion, if you are looking for monthly income. You just can't get over that total return with a very awesome starting yield that has incredible growth behind it, leading me into my second favorite. This one is the current one that I have a large exposure to within my family's portfolio. I am considering adding XDIV for a bit more diversity. I would not make either one of these ETFs an absolute solidified end-all be-all solution to investing, because again, they're not as diversified as say something like an S&P 500 index might be, in my opinion. I would just use these to start helping, again, think about the diversity of income and having some really solid, ETFs in one's portfolio. So VDY, again, 44.62% of everything we looked at here, with VCE being up 53%, ZDIV over the last 5 years up 31%, XDIV up 39%, puts this in the second best performing capital return next to VCE so far that we've looked at. And that's because it, again, has highly concentrated exposure. And I like VDY because, unlike the other ETFs, it does the same thing VCE does and the S&P 500 does. It focuses on the Canadian core dividend stocks that are based off market cap weightings. So because of that, we have Royal Bank at 15.9 and Toronto Dominion Bank at 10%. That means 25% of this entire ETF is going to 2 stocks. So just think about that. For every $10,000 you put in this ETF, 1,500 of it is just going to Royal Bank. This is something you got to take into consideration from a diversity standpoint, because if you made this 50% of your portfolio and then say put the rest in something like VFE, which is the Canadian ticker for the S&P 500, you'll notice that Apple, Microsoft might be the upper weighted stocks, but they'd only be weighted at say 7 or 8% or something like that at max, I think. And I don't even think it's that much. But even if it is, you're going to actually be overweight Royal Bank, which you might be comfortable with. But again, if this was my core portfolio, I'd be a little uncomfortable with the total weightings in here. But again, Toronto Dominion, Enbridge, Canadian Natural Resources, many of the stocks that you're going to recognize with, again, 56% financials, 29% energy, and then utilities at 6%. So most of this ETF is just energy and financials. And again, the concentration tends to lead to better performance. Now, the management fee currently is 0.22% with a starting 12-month trailing yield of 4.43%. So again, this is falling in line with everything I like to see. It's right in between my barrier. I don't like paying more than 0.3. 0.1 is obviously the best with XDIV. So this is still a very healthy management fee with an incredible starting dividend yield today. Now, if we take a look at the total return since inception, they're lagging behind XDIV just slightly here at 9.91%. But again, guys, absolutely insane. You look at the 1-year performance of 27.34% and almost that 10% since inception. I don't think any of us are really complaining here, but XDIV takes the cake. And I think in this current market environment for diversity, you could probably actually just pair both these together. Or again, XDIV, it seems as the best appealing in the current market environment with the best 1-year return and the best since inception return thus far, right? So this ETF, again, you really start to kind of digest what we're looking for when we're making long-term investments. And a lot of people are going to get caught up in yield and return, right? So VDY as well has a 7.985-year growth rate. Again, absolutely stellar. Again, very in line and actually beating slightly XDIV. So VDY gets a little bit more of a take there, but that's probably because the upper weightings in those banks, which tend to have really good dividend growth rates. But people are going to chase the dividend yield, and they're going to look at things like HMAX. And I don't think there's anything wrong with looking at, basically option-oriented ETFs, though I always recommend that you should learn options yourself and write options against your own ETFs or something like an S&P 500. It's safer. You pay less fee, which we're going to see here because the Hamilton Canadian Financial Yield Maximizer is one that has come up a lot. I hear about it all the time in my comments section, and the holdings are just that. It is a basic bank-oriented option ETF. They're going to write options and they're going to basically try and get you a massive yield. And I want to scroll up and show you that this current yield on this ETF is sitting at about 14.16%. Which is super high. And that might draw you in to be like, oh, I need to buy these option ETFs. I need that income to pay my bills. But I always recommend understanding, again, inception-oriented returns. What am I likely to get over the long term if I were to just put my money in another ETF? Because that yield, though you're collecting it, and you're going to pay probably tax on it if you're not careful, holding it in tax-advantaged accounts, but you keep forgetting that the stock degrades over time. You're paying a very high fee, which doesn't get included usually in the total returns. And since inception, we've only got 8.91%. And on the 1 year, with the markets exploding, we've only got 24.36%. So even with the best year we've experienced in the market in a while, with the absolutely absurd yield this offers, it's really still laggard all the other ETFs that we basically looked at, right? So again, you're giving up some return just to get that income, whereas you could just sell some of the stock off. And I think it's prudent to understand there's nothing wrong with selling stock. It's the way Warren Buffett thinks. Warren Buffett's idea is if we can retain the earnings and invest it better, which is going to increase the share price higher than paying it out to you in a yield and having to pay tax on it, then you can just sell some shares at some point, which is the equivalent of taking a return, right? It's kind of like the idea if you own the S&P 500 and it goes up 10% and you pull out 4% every year, you're still going to be capitalizing on more over time than you're still taking out in the share count. So I want to keep that in mind, and I hope that kind of made sense because if we compare it to even the likes of ZEB, the BMO Equal Weight Index, which basically doesn't, do any options. It's just purely holding the banks. And we take a look at the since inception return, it's been 11.58%. So again, 11.58% versus 8.91%. And if you look at that 1 year here, guys, the return has been 34%. So if you were to just focus on a Canadian fixated bank ETF, you would have, gave yourself an extra 10% return. So you left 10% on the table chasing a yield. And I want you to always keep that in mind, that total returns matter more than income. So when you can get a 4 to 5% return, especially the 5% that we locked in when we were buying VDY and some of these other ETFs, when you lock them in when they're on dips and then you get this market performance behind it, I think it's the fastest way to really generate healthy, growing passive income and not leave money on the table when it comes to total returns. Again, I'm not against option ETFs. There's a lot of great ones that you can look at that are out there. I just find that because the management fee and HMAX, they really kind of go out of their way to hide it, because you'll notice that it's not up at the top next to the dividends. You scroll down, you don't really see it sitting in here anywhere. They just show returns. They kind of try and get you excited. But then when you scroll down here, you'll see that the management fee is 0.65, which is far too high. You might as well pay yourself to write your own options. And this is just one man's opinion. You do not have to take it into consideration, but what I really want you to take into consideration is total returns. Facts don't care about your feelings, and I want you to join this fast track retirement that so many of us are experiencing. And I'll pass the question off to you. I'd love to know what you think in that comment section below.